Good morning, everyone. Today we are going to be talking about GameStop and the short squeeze that's going on with that. If you like the video, please like and subscribe. And yeah, let's get into it. What is up, you guys? Good morning. GameStop, GameStop has been in the news a lot recently. I don't know why I can't say it. I've made this video 3 times now, and I cannot get GameStop out of my head. I keep saying GameStock. So if I say that in this video, I'm talking about GameStop, GME, the stock that's been short squeezed for the last year. So let's talk about it. What does it mean? What's going on here? What we've got going on is 2 different strategies from 2 different traders in the market. On this side, we've got hedge funds. On this side, we've got pocket traders. So first off, let's talk about the stock. Let's talk about the company. GameStop, it's a retail establishment company. It's a retail business. They had their heyday. It was like when I was 12, 13, 14, where people would camp in strip malls and in malls around the country waiting for the newest game to come out. And as times have changed with Amazon and people downloading more and more of their games, GameStop has really taken a hit. You know, they've really been affected by this. And over the years, their stock has gone down. So about 1.5 years ago, GameStop was, between like $4 and $9, and it would kind of bounce around there. Definitely kind of looked like it was in its death throes. There was like GameStop's also closing down around the country. The business was doing a lot to try to preserve itself. So the different strategies here. Let's talk about what they're seeing. What the investors are seeing is they're seeing a failing business. They're seeing a business where if everything goes logically, the price should continue to go down, because we think as a community that GameStop probably isn't a good, wise investment. I mean, I download all my games nowadays. I don't have a disc. So that's what is seen. So that's what everybody's focusing on. So first off, let's talk about the hedge funds. The hedge funds, when they see this particular problem, so they see a faltering company, what they want to do is they want to sell their shares. B, they want to buy options that will make money as the stock goes down, and they do that in a few ways. Most notably, what they do is they do a short sell. So the short sell is, let's say Bo's hedge fund is seeing this in the market, but I don't own any GameStop. My Mackenzie hedge fund happens to have, let's call it 1,000 shares of GameStop available. And I say, hey, you know what? I want to borrow your 1,000 shares of GameStop, and I'll give them back within a certain time frame. And then we agree upon a time frame. Maybe it's 2 months, maybe it's 3 months, maybe it's a year. But we agree upon a time frame and a price. So, let's say GameStop is at $4. So they say, okay, you know what? Here, I'll lend you the 1,000 shares of GameStop, and you can hold on to them. Now, what the hedge fund is trying to do is they are trying to buy as many shares on the market as possible for as little as possible, and then return those back to Mackenzie's hedge fund, and then pocket the money in between. So, hey you guys, Bo from editing here. Just wanted to clarify something here. What the hedge fund is doing with this transaction in the short sell. So the Bow hedge fund is borrowing that 1,000 shares from Mackenzie's hedge fund and immediately selling them. So they're selling shares they don't have, and then trying to buy those shares back for a lower price on the open market and return them back to the original hedge fund. So I recognize that in the video, I didn't explain that they're selling shares that they don't have. And that's a very important factor to the squeeze. That's what puts them in this position, is because they've sold those shares that they no longer, that they need to return to Mackenzie's hedge fund. So anyways, that's what the short sell is. It's, it's hedge funds taking shares and saying, I will give these shares back to you at a certain date or by a certain date. The danger of this is if the stock continues to go up rather than down, your margins start going in the wrong direction and you wind up having to repay those 1,000 shares at a loss. You wind up having to buy stock off the open market for $4, $5, $6 per share, rather than what you expected, $3 a share. If you could buy them back at $3 a share off the open market, put them in an envelope, so to speak, and give them back to your other hedge fund, you've made $1,000. You've made a dollar on 1,000 shares in between. Now, the hedge funds are really doing this over millions of shares. So that's what's going on. That's kind of what the short sell is. That's what the hedge funds are doing. Now, they do this in combination with a few other strategies, but that's kind of what the other side is focusing on. So let's talk about the other side. Let's talk about the pocket traders. We're over here. The pocket traders are like me and you. We're just normal people. I don't have a hedge fund. I'm not rich, I'm not wealthy. I'm kind of poor. I trade daily because it's fun. I like it. It's a challenge, but I'm a pocket trader. I leave my retirement with Edward Jones. This is what I do for fun. I'm not trying to go buy a Lambo. I'm just trying to learn, have fun. I've been trading for 2 or 3 years. And yeah, so pocket traders are a whole nother animal. I'm willing to lose $100 or $200. And I think I'm down $1,500 over 2 years, which is not great. Like I said, because I don't have a ton of money to throw around. But the pocket traders, we have a lot less to lose. And there's a lot more of us, especially with the introduction of Reddit, Wall Street Bets, things like Discord, Line Chat. It goes on and on. There's just this massive network of communication around Wall Street Bets. And the pocket traders have identified this flaw in the hedge fund strategy. The flaw being that if people buy and hold these stocks, the stock goes up, even when it shouldn't. And it rewards all the people buying and holding. The hedge funds get burnt and they wind up having to buy back more shares off the open market, thus driving the price up even more. The downside is that when this happens, it normally happens on a very, very small scale. We're talking, movement of $1 or $2 and it shocks everybody. But what happens is more people like myself recognize that stock as something that just piques their interest. I know I'm always interested in the daily movers. So a little bit more people invest their money. And the hedge funds go, oh man, this company is still a distressed company. We should put more money against it. And they do. Now, if you have access to, the options order book on Webull, M1 Finance, you'll see, oh, look at all these options opening up. And it implies a lot of volatility. So more people invest and more people buy options. And you get this, this cascading effect of people buying the stock, people betting against the stock, more people buying the stock, more people betting against the stock. Now, typically there's some ebb and flow with this because not everybody has iron hands. Iron hands, by the way, means you hold everything until it dies. You never sell. You never let go of a position. The opposite is paper hands. You buy something, it goes down, 1 cent, you sell it. So typically you have a mixture of these personalities in the stock market. But with the introduction of Wall Street bets, you have these people that want to hold the stock because they want the short sellers to be punished. You look at Elon Musk with Tesla. He's got a war against short sellers. And I think he goes out of his way to pump that stock, sometimes in ways that I find kind of sketchy. Like they'll unveil new product lines and then cancel them, or it just blows my mind what they get away with. But it's a fight against short sellers. All for it. The downside is, Tesla's way out of my budget. I can't even afford options on Tesla. So that's kind of what's going on. It's two competing strategies. The position that the hedge funds wind up in is dangerous because as day traders or pocket traders buy up all the shares that are on the market and hold them, it drives the price up. These hedge funds, they then buy more shares at a loss to return back to the other hedge funds or to whoever they borrowed them from. It's dangerous for the day trader because these hedge funds, they're not dumb, they're not in the dark, and they're going to start mixing up their strategies. They're going to start mimicking Wall Street bets. They're going to become Wall Street bets. So what's going to happen is there are going to be pocket traders left holding the bag when this thing falls out. So it's a dangerous game to play. If you want to get on board with like the next Wall Street bets run, I will say it's not easy. I mean, I'm following Wall Street bets like on a daily basis. And the other thing that happens like with the options chain is this thing that's called pricing in. So people recognize when something's being pumped and they start pricing their own options and their own stocks accordingly. So it's a really hard moving target. You've got to be really plugged into the market. But what I would be looking for is I'd be looking for struggling businesses that are in the daily movers, constantly going down, that have a widely known public reputation of being a faltering company, like Gamestop, like AMC. So yeah, that's what's going on with GameStop. And I don't know why that comes up, man. Anyways, I've got some editing to do. Oh my gosh. Okay. I'm not going to edit. I'm just going to talk about this. So I got a notification 20 minutes ago that Robinhood is restricting trading on GameStop and AMC. What does this mean? Why are they doing it? I suspect they're doing this because of, they say it's due to high volatility, but you got to look a little deeper than that. What does it really mean? Robinhood is a poor man's brokerage. They're trying to make money any way they can. They're middlemaning trades. They're selling your trade to other brokerages. They are buying shares and then trying to sell them to people trading on their application later at a higher price. Robinhood is a full-blown brokerage. I can't say that because you don't really have 20, okay. They make money every way they can. That's really the truth of it. So I imagine with GameStop and AMC being so volatile and moving so quickly due to the battle of the titans, pocket traders versus hedge funds, they're probably losing money. They're probably, buying these, they're probably having to buy GameStop from other brokerages now at a loss, and they'd rather do that in-house. So right now what they're doing is they're doing closed positions only. Does this affect what's going on with this battle of hedge fund versus pocket traders? A little bit. It does, because Robinhood has the most people on it. So you're not going to have more people buying the stock and driving up the price. You will have people able to close positions. So that's not good. You know, you don't, in this position as a pocket trader, you want the trade to go up. You want the stock to go up. So you want everybody to hold. Having the only option to close, to sell, is not ideal for the pocket trader. So yeah. On the other hand, I've got an account on Webull. I've got an account well, I think I had an account with Capital One Investing, and then I think they sold it, so I don't think I have one there anymore. So yeah, Webull, M1 Finance, Capital One Investing, E-Trade, Tastyworks. People have options. So I don't think this is really going to slow down this landslide that's happening. I think that ship has sailed. So yeah, that's what's going on with GameStop. I hope this helps. I hope this brings some clarity. And I hope I don't have to edit this again. All right, you guys, late.